Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, Roy Matlock Jr. Today, we are going to talk money, as we always do. And what I'm going to do today is kind of go through what I would call the, just setting up the plan. And when I think about that, it's very similar to, you get your GPS when you get in your car. Nowadays I don't even know how I made it back in the prehistoric days where I had to get a map and look around and try to find where I was going. But now you just put in your GPS and it says where you want to go. And you're like, I want to go to this place. And you pick out your restaurant, whatever it may be. And then it says, here's your directions. Here's the plan. And then you're going to arrive in 12 minutes or whatever it may be. And that's kind of what, the GPS to me is. It's kind of like, okay, the goal, the plan, the schedule. Well, when it comes to money, if you think you're just going to show up and be set for life, well, you are not going to have that happen to you. And so what we do in our company, we are an investment advisory firm, RMJ Advisory. We also have an insurance marketplace. We work with small business owners to help them find ways to, position their business to where one day they can, maybe sell it one day. And we work all the way through the consumer side, from young, middle, and older retirees that may want to pass money on at one point in time, when they're gone. So we do all that kind of stuff. And in each case, we do a GPS. And anytime I meet with someone, the first thing that we want to do, if you meet with one of our advisors, we usually start out and ask you, what is your goal? Why did you take the time to meet? And we get all kinds of things. But generally speaking, the business that we're in, it's something happened. You're getting near retirement, or you're concerned about the stock market, or you're had a baby, or you changed jobs, or you're inheriting money, or, you're worried about, if something happened and you went in the nursing, whatever it may be. If you're a business owner, you're thinking, hey, how do I keep my employees and get some of the risk of maybe responsibility off of me to be able to provide benefits, whatever it may be. So we go in and we find out what the goal is. And generally speaking, when you meet with someone like us, we do a review and we give you your diagnosis up to this point in your life. And when I meet with people, it begins with, what's the goal? If it's okay with you, we would like to just get some information from you, find out where you're at. Worst case, we will give you some advice, and that advice, you can take it with you. And so if you're tuning in now, I would encourage you to take our offer, which is a 30-minute phone call to do a comparison on where you're at, or just call it and get caught up. Worst case, you're going to get a lot of good advice. You can go to RoyMatlockJr.com and schedule that, and it's free, and it's low-key, and it's very low pressure for sure, because you're on the phone. And that's how we always start with people, is doing it that way. And then from there, we would go in and work on a plan. What is the plan? Well, generally speaking, we take a look at, what do we need to do to fix where you're at this point? Maybe you're not, fully investing at your capabilities, or maybe you've got it too aggressive or too conservative. I met with a client just recently, and they had gotten a little skittish on the market, and now they are out of the market. All right. And so now, how do you get back in? All right. How do we do that? And had another client that I met with, and they showed me their statements on their investments, and they had 4 funds, and those 4 investment funds matched up the same exact stocks over 25 times. And so even though they had 4 funds, different fund names, they really weren't diversified. So we start looking, we say, where are you at? You got some debt. Well, let's figure out a way to get you out of debt. Let's get an emergency fund. We do all these kind of things. We look at where you're at. I see people with, credit card debt, and then they got money sitting in the bank, and they're borrowing at 21%, and they've got, credit card debt of $10,000, and they got $15,000 sitting in the bank and stuff like that. So I say, hey, you want to get 20% on your money right off the bat? Let's just pay off the credit cards with the low interest money. So we do that, and then from there we start looking at the plan. How do you create a plan? Well, the plan is always 2 things: a defense and an offense. The defense is to keep you from making mistakes. A typical mistake you make when it comes to your money will cost you $50,000 to $500,000 over your lifetime. The sooner you make the mistake, the more it's going to cost you because there's more time involved. And so we don't want to make $50,000 to $500,000 mistakes. And so we go in and we say, let's see, what do we have here right now? Well, we got too much debt. That's why your credit card bill is going up every month. And why is the credit card going up every month? Because you got big car payments and this and that and the other. And so we need to fire some expenses and get back on track. So then we look at that. We create a defense. Anytime you build a defense, the idea behind a financial defense is we're going to protect our income and our assets. It's not a matter of whether or not we're going to have a problem. It's just as to whether or not we're going to be prepared for the problem that we're going to have, because that's called life. And so we're going to put things in place to protect our income, our assets. We're going to protect our assets. Maybe it's an emergency fund to keep us from having to cash in our retirement plan early, all those different things. And so what happens is we put together that plan. The defense starts it, the offense grows it, and that has to do with your retirement plans and your college plans for your kids, and having the right asset allocation and dollar cost averaging and taking advantage of taxes and all that kind of stuff. We'll add a will and a trust into it, and we get that moving, and then we're going to implement it and automate it. And so one of the big tips I always tell people is you automate everything. You automate what's going out, but you mainly automate what ends up staying in your name, which is called your investment account. So we turn around and we pay ourselves first, and we start getting things moving. And so today's show is going to be all about putting together a plan. And I always talk about the plan. And when we put that plan together, what it's going to allow you to do is to take the financial stress off your plate. And we are implementers. That's what I do. I implement. I meet with people. I say, look, when we get done here, we're going to have a plan, and we're going to implement the plan. And then once we implement that plan, your job is simple. Make sure that you keep the money coming so we can put it to work for you. My name is Roy Matlock Jr. I would encourage you to go to roymatlockjr.com and check out some of our free resources. We will help you make the move to financial independence. We will be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit roymatlockjr.com. Now, here's your host, Roy.
All right, Roy Matlock Jr., if you're just tuning in, today we're talking about putting together a plan, a financial plan, and that's what we do is we work with individuals and business owners to position themselves for success when it comes to your money. And I would encourage you to check out some of our free resources. We have everything from budgets to, being able to get instant life insurance. If you're underinsured, you might want to look at term insurance, get that done in 15 minutes. That includes a will and a trust. All of this is at roymatlockjr.com. But one of the things that I just did years ago, I did a thing called a family financial workshop. And of course, that family financial workshop started with my family, because I'm fortunate in that I have a mother that is 101 years old. There's 5 generations of kids, and there's 5 of us, and there's it's like a multi-level marketing company with 3 that got 3. Well, we got 5 that got 4, that got 3, that got 2. I mean, it's crazy. It's like we got more kids running around everywhere. And so one day I decided, I said, if I'm going to take it all the way down to the deepest generation, every one of them should learn or be started out with having a little mutual fund. And so we set up a growth fund for all of those kids, babies, all that kind of stuff. And we do that. And one of the things that I think is cool about it is for $250, you can set one of these things up rather than taking it to a bank. And then they can add money to it at any amount, anytime. Even better than that, they put it on a monthly basis where it drafts their checking account. So you go to the bank, you open up your son or daughter, or granddaughter, whatever, grandson, you open them up a little small checking account. And then when they get a job, they can just hit a button and they can invest their money, and you get them started investing rather than saving. And that's the key to getting ahead if you start them young. Can you imagine? Just ask yourself the question: when you were born, if someone had done that for you, and then when you were you're very young, rather than going to the bank and getting a little bank account, they had told you, let's just put it into investments. And then by the time you're old enough to understand, you're a teenager, you're like, I'm making money at my part-time Wendy's job, and I'm going to save that money, and I'm going to put it into investments, that kind of deal. And one day you're like, wow, change the family tree. And so I would encourage you, if that is motivating to you, reach out to us. We'll set those little accounts up. And clearly, we're not in the business of setting up those little accounts, but if we can help people change their family tree, that's good. And so today we are talking about setting up the GPS, the goal, the plan, the schedule. Starts with, where do you want to end up? That would be a number called the financial independence number. So let's think about that. So I always start with someone, and I say, let's take a look at what we know we have coming when we retire. And you go to the Social Security website, you put your age in, what you're making, all that kind of stuff, and it's going to tell you when your full Social Security is, and you're going to find out that you're going to get $1,000 to $4,000 a month. If you really, are the top end, and at 66 years old, whatever that may be. And so then you say, well, how much do we need to be able to survive? And so the first thing I do is I look at it. I say, well, if you were to quit today, what would be your ideal income? You say, oh, I need $100,000 a year. That'd be great. I'd love to have $100,000 a year, do nothing money, that kind of deal. And generally, to make it safe, I just say multiply it by 20. All right. And now we've got a $2 million number. And then we say, well, but we need 20 more years before we're going to retire. So let's just double it every 20 years. So they need 4 million. So your number is 4 million. That is your number, your financial independence number. So let's do it again. 20 times our desired today's income. Every 20 years, you need to double it for inflation, and you get your fin. So 50 grand a year is $1 million. 20 years from now is 2 million. If you're 25 years old and you're thinking 40 years out, it would double twice. $1 million would go to 2 million, go to 4 million. You need $4 million, whatever it is. Once you get that in, that is the number that you need on the back end. We then back it out and we say, well, what is it at this interest rate that we would need to be setting aside in order to reach that number on a monthly basis? What do we already have saved? And at this interest rate, what would it grow to? So you say, I got 100 grand saved. And you say, well, that's going to double at 9% every 8 years. We'll have a couple doubling periods. So there's 200, 400. Now I'm short 3.6 million, whatever that number is. And I got this many years left, and divide that out, and we give you a number. That is the plan. We got a plan now. We got a goal. Now we're going to start on the plan. And the plan is we need to set aside this much per month on a regular basis if we get this type of rate on our money, and we begin the process. And I will work to find ways to get that number. And how do you get that number? Well, we may have to make some adjustments to some of our spending. and starts usually with a budget. Had a client not too long ago, had a $900 car payment. And I'm like, well, you got a $900 car payment and you got a house payment, you got all this kind of stuff. And so as a result of that, you have credit card debt because you're spending more than you make. You have equity in this car. And so the car's worth like 50 and was owed 24,000 on it. So why don't we just take and eliminate that and get sell the car, take the difference, pay cash or something cheap, and then we have $900 a month, and we'll pay the credit card off. And guess what? You're in business. You go from struggling, all right, because of one bad decision, and you're going to struggle forever unless you make a change. So we go in and we fix it, all right. So that's part of the plan. That allows us to then start saving that $900. And I can tell you this, that if you just make a decision, never going to have another car payment, and you're going to pay cash for cars, you'll always do good. So anyway, so that's the starting point. So then we create the plan. We're going to invest here. We're going to take advantage of retirement plans, all that kind of stuff. And then we're going to do a review. And in that review, we're going to review our defense. That's our insurance, our wills, our beneficiaries, all that kind of stuff. We're going to review the offense, the investments, the performance, the asset allocation. And we do that. We do that typically once a year. We look at any new goals. We add that into the process. I have people call me that have been clients of mine for years, and they call me up and they say, hey, I'm thinking about doing this. And I'm like, nah, I don't think that's a good idea. All right, I don't think you're there yet. Or they say, well, we're doing this. How do we do it? I say, okay, well, here's what you got to look at. This is what the cost is, to be able to do it. And here's your best way of doing it. And that's where the annual reviews come in. So if you work with a financial advisor, what happens is if you find someone that really actually knows what they're doing, which there are good ones and bad ones in anything you do, what you're going to find is that you're going to get advice that will help you to avoid bad decisions. And we don't want to make those bad decisions because they're costly. And especially as you near retirement, it can be very devastating. So one of the things I would encourage you to do is check out some of our resources. I believe that education is important. I believe that understanding to where you can explain something to your friend as to what you're doing is one of the key elements as to whether or not you're going to go in a good direction. So if you right now have your finances in place and you cannot explain whether or not your insurance is going to pay off, and so if something happens, or if you're not sure about your asset allocation, if you don't have the answers, then you probably need to get with someone that has an educational approach. And I've always done this. I've been on the radio going on 30 years, and I try to do that because I know that you can make good decisions if you're given good information. My name is Roy Matlock Jr. I would encourage you to visit roymatlockjr.com and download some of our free resources. We will be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit roymatlockjr.com. Now, here's your host, Roy.
All right, we are segment 3 when it comes to building your GPS call plan schedule. We're going to now get into details on setting up the defense. We will then, in the final segment, work on the offense to get you growing your money. And so let's talk about building the defense. Step number one to building the defense is something called a budget. Now, how do you set up a budget? Well, a budget it starts by, going in and finding out where you're at. And so I can tell you that if you have credit cards and car payments, you are overspending. And that's why you have credit cards and car payments. Spend more than you make. And if you spend more than you make over a long period of time, you go to stage two of spending more money than you make. It's called going bankrupt. It doesn't work. Businesses do that. It's very simple. You see businesses come and go. It's amazing to me in Nashville, especially, how many restaurants you see. Oh, I remember that restaurant used to be there. I remember that one used to. Then a new one comes in, then the new one goes out of business. It's real simple. They just spend more than they got more expenses than they have income, and they eventually close. And that's what happens on your personal finances. So the personal budget is very important. We have a budget calculator. You can go to roymatlockjr.com and do that. We then go in, and when I start with people, I always tell them, I say, look, so at some point in time throughout the year, fire all your expenses. Maybe it's an annual review, and you go in and you say, I'm going to fire all my expenses and keep all my income. And when I do that, I got a clean slate. Now, keep in mind, we can't just fire the expenses, but we can sure make the assumption that some of them need to go. And so what we're going to do is say, well, knowing what I know about this, if I'd never done it, would I do it now? And you'd say, nope, wouldn't do that. How do I get out from underneath it? All right. If you bought that expensive car, and if you had to do it over, you'd never done it, then you say, know what I know? How do I get out from under it? And you go through all of those type of things, and you rebuild it with an idea that you have a goal of about 25% left over at the end. If you're in debt, clearly you're not going to be able to do that. And what I mean by debt, meaning bad debt. All right, bad debt is debt you can't afford, debt that depreciates, the item that you purchase depreciates. It's not, I'm not telling you to go pay your house off. That is as dumb a thing to do as, my cohort in the past, Abe Ramsey, says is as smart a thing to do. If you've got a 3%, 4%, 5%, even a 6% loan, paying your house off to me is not a good move. It's a bad move. And so that's called good debt. And as long as you are able to pay the payment comfortably, then I would not go do that. I see so many people, they get all fired up about paying their house off. And then when they get to retirement age, they got their house paid for, but they don't have any money liquid. Then they need to go do a reverse mortgage, or they need to sell their house in order to downsize, in order to get some cash, in order to live on. So we're going to eliminate bad debt. Bad debt is debt that you can't afford, debt that is tied to something that depreciates. It's fine having good debt. What is good debt? Good debt is an affordable mortgage. You get leverage. What is good debt? Borrowing money if you're a business owner for equipment or expansion that you can easily afford to pay that will help you earn more money. That is good debt. We then go in and we build out. Once we understand these things, we've got our budget. We're going to have an emergency fund, 3 to 6 months of cash. If you have a bunch of equity in your house, you set up your equity line of credit. That's your second emergency fund. It's interesting. Banks love to loan money to people that don't need it. But if you need it, you can't get it. And so you always get your equity line of credit. We have referrals to that that will allow you, while you're working and solid, you can get it. And then that way, if anything happens, that you do have something happen, which it will happen. It always does. You never know. I mean, I can tell you stories, you're cruising along and then something happens and, you have a accident or sickness or something like that. And then your finances, you're prepared. You've got your emergency fund. You got your second mortgage. You don't have to dip into your, retirement plans and stuff like that. We're going to then protect our income, and we buy term life insurance, and you can set aside a few dollars a month and get a big return. And, I tell people term life insurance is for your family. It's not for you. It's for your family. It's income replacement. It's the one place that you can put money into and that will pay off more than anything for your family. And what I mean by that is that let's say you are 30 years old and you go, get a term policy for $1 million, 20-year term. You might pay $50 a month, for that. And if something happens to you in 2 months, we don't know our date of death, and we put $100 in and it pays $1 million. Why wouldn't you do that? And the other side of it is that it's some of the most low cost coverage that you don't use. So you buy it to protect your income. I also recommend that you have within those policies now, they become pretty cool, called living benefits, to where you can actually access the benefit in the event you have some kind of illness, chronic illness, whatever it may be, critical illness, whatever it may be. There's like 18 different ways you can get the death benefit while you're living when you need it. So anyway, so I would recommend that. We also buy life insurance that we would keep. That's called permanent life insurance. It has generally 3 benefits to it. You can you buy it. It has a death benefit. It has tax-free growth or tax-deferred growth, tax-free withdrawals, and a tax-free death benefit. And so that's something you can keep. It's an estate planning tool, legacy type thing that you would do. We would also look at disability insurance. That's in the event that we become disabled. It pays us an income. And so those are things we protect our income and we protect our assets. Liability coverage is to protect the assets we have. We get in a wreck, we get sued, we have liability coverage. Our home, something happens, we're protecting the asset. It replaces the home or the car, whatever it may be. We protect our income by buying income protection. Or we replace our assets by buying asset protection. What would be another asset protector? Long-term care. That can be something that would wipe someone out. So we do that. We look to protect our income. We buy annuities, and that gives us lifetime incomes. So we do all those kind of things, and then we wrap it up with a living trust, a healthcare directive, a power of attorney, all those kind of things. And so when you're building your defense out, it's a plan, all right? And what we're going to do is we're going to keep from losing by putting together a great plan of protection. That is what it is. So we're going to avoid the bad decisions. We're going to build a defense, and that defense is going to allow us to go on the offense. And so what I generally tell people is what we're going to do to start with is we're going to get in place a plan to keep you from making bad decisions early on. We're going to keep you from being in a position of weakness. And what is a position of weakness? You lose your job and you don't have anything set aside. And then the compounding of bad things happen. Then you have problems paying your mortgage, and then you have problems keeping your house, and then you have problems, all these kind of things that don't have to happen. And so if you want to build a solid defense, it is a plan to build a solid defense. And we have that. We have a lot of resources to do that. We are an advisory firm. And if you would like to do a phone call, 30-minute phone call with one of our advisors, they'll walk you through building the defense, shop around to make sure you get the best rates on the things that you need that fit you, and then we get you started. And once we get you started, we then take it to the next stage, which is we go to the offense. The offense allows you to take advantage of tax saving things and retirement plans, which is what we're going to be talking about shortly in our final segment. My name is Roy Matlock Jr. If you'd like to become a licensed referral partner and refer business to us, maybe make a career change, you can also visit roymatlockjr.com to find out more. We'll be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, we're in our final segment today, talking money. My name is Roy Matlock Jr. If you're just tuning in, we're talking about building the GPS goal plan schedule when it comes to your money. We've been talking about a defense. The defense keeps you from losing. It protects your income, your assets, your money management. That would include budgets and going out and making sure that you have a plan to keep from losing, avoid the mistakes, and you get on track. And so what we do when I meet with people, it's very, very clear. And all of our advisors, we operate under the mindset that, number one, we start with, where are you? This is here's where you're at in your point of life. Up to this point, you're 45 years old, and let's see what you've accomplished with your money. What do you have? What do you owe? Where are you at? Where can we help? And in this 30-minute phone call we do, and it's always a phone call, what we do is we can give you advice. Hey, you should change this, do this, regardless of whether you end up hiring us to be your advisor. We start with that. We then take a look at some advice that goes along with that. And that advice would be, maybe you're not fully funding your retirement plan and you could, or whatever it may be. Raise your deductibles. Here's how you set up a budget. We do that. We then set up a defense to keep you from losing. We then go to an offense to grow your money, which we're going to talk about right now. And then from there, we go out to a product marketplace. As a fiduciary, we have access to, thousands and thousands of investment products, and we have the same thing in our insurance marketplace, where we're not tied to any one company or any one product. It's interesting about insurance companies target certain demographics, and so as a result of that, you may be in the wrong demographic for the insurance company, and so you're not getting the best deal as a result of it. So we always tell people that you should work with insurance people that also, at the very minimum, have a investment advisor that they partner with. Preferably, if you have all of it, that would be that much better. And then that way, there's no direct conflict. We are not pushing a product because we have access to all the products, and we are not pushing in a certain investment because we have access to all of it. That's what a fiduciary does. And so then what happens is the offense comes into play. So the defense keeps you from losing. The offense wins the game. What are some components of the offense? If I said, what's the first step? Well, we need to understand what causes money to grow. It's called the rule of 72. It tells you how long it takes your money to double. If you've never heard this rule, I learned this 40 years ago, and I started figuring out, man, if I'm getting 4% on my money, a lump sum will double in 18 years. But if I'm getting 10% on my money, it'll double in 7 years. If I get 12%, it'll double in 6 years. Would I rather have my money double every 6 years or every 18 years? That's pretty simple. So how do I go about finding where to get that money that's growing and working harder for me? And so, interesting enough, I got involved. I got my securities license in 1985, and I was introduced to something called a mutual fund. That's where people mutually fund money into a big investment pool, and a professional money manager goes out and chooses different companies, stocks, bonds, and or a combination thereof, and they invest that money, and over a period of time, they tend to do pretty good. My original fund that I got involved in is almost 100 years old now, and it's averaged 12%. So they've been able to double the money every 6 years for 100 years. It's pretty good. And so it's out there. And those are accounts that don't require a lot of money to open. $50 a month was what I got started with it. And so I started understanding that, wow, there's more than the bank out there. I can find something that will take someone that's small and be able to invest like someone large. And that's what a professional money manager does and how you can get started like that. And so then over time, what we do is we learn to asset allocate. We do something called dollar cost averaging, which is nothing more than having a regular, consistent monthly uh, draft or your paycheck. Maybe it's weekly that goes into an investment, regardless of the price of the stock market. We're not timing the market. We're using time to win over the market. And when you put your money in over a long period of time and you have it properly allocated, you have professional money managers managing it, what you do is you end up having good results. And that's what we've been doing for years. We then go in and we decide when we're working with people where their place in life is. And what I mean by that is if you're younger, you have longer time horizon. So therefore, it would make more sense that you would have a bigger risk tolerance so you can have ups and downs because you're like, hey, I don't care. I've got 30 years before I'm going to use this retirement money. So I hope it goes down. I have people right now, I tell them that when you get older and you have a big lump sum of money, we want to back it down a little bit. And you got 5 more years, and we hope the stock market goes down. And then that way you're buying. And so you're buying in the growth mode and your big lump sum, which is going to be your main thing, we backed it off. And so you can have money and say, I want the market to go down, but I also want it to go up eventually. And so we go in and we do that. And then we start taking advantage of understanding, the way asset allocation works based on your time horizon. We do those kind of things. And then one day you turn your investments, your assets into income, and then we have an income plan. And so we do things like that. And so the offense is about growing. What are some examples? 401k, where you can put in pre-tax dollars. And in many cases, I'm going to recommend that for a lot of people. And then they can buy one and get one free. They can deduct their 401k, get a match in many cases, and take that tax deduction and maybe stick it into an IRA, maybe even a Roth IRA. And then we have some different income streams from tax-free. We have tax deferred. And then generally speaking, if you have money in non-qualified money, it's liquid, meaning you can get to it, but at the same time, you have to pay taxes yearly on it. And so what we do is we just put together a plan. What I'd love to see happen for people is, if they're doing everything we tell them to do, they're going to have some taxable liquid money when they retire that they can draw on. All right. They're going to have some tax-free income, possibly a Roth, that they can use that for income. They're going to have some tax-deferred money. That might be an annuity that a portion of it is taxed and a portion is return of principal. They may have some life insurance that's tax-free that they can pull on. And then they may have some traditional retirement accounts where they have an RMD they have to start drawing, but they've been deferring that money all that time. And so now you got 5, 6 income streams when you retire. I'll give you some examples of the way I typically approach people when they retire. We have tax buckets, and we have buckets of different types of investments based on with one goal in mind is that we're not going to be selling on the down. And what that means is that we may have some annuities that give lifetime income. We got Social Security that gives us lifetime income. We have some stock funds that allow us to have growth but have volatility. We have some bond funds that allow us to, have a little more stable income. And we have a little bit in cash, meaning money markets, which allow us, if we have down markets, that we can pull from that. And then what we do is when we start retiring and pulling money out, we look at which one makes sense. Just had some money that I pulled out for my mother to live on, and I went through just like I always do, and I look at all the different asset allocations, and I take market conditions, and I say, all right, where are we going to pull from? Which one are we going to pull from? Which bucket? Which is the tax bucket that makes the most sense? Which is the bucket that makes more sense as it relates to market conditions? And so we do those kind of things. Some common mistakes that I see with people is they try to time the market rather than time in the market. They think they're allocated, and they're really not. They have very similar funds. A lot of times today, it's a little bit more difficult if you have a big portion of your money in your retirement account through work. If you don't have someone watching it, then you may be mixing it up or matching it with some of the other investments you have, and you don't really have diversification. One of the biggest mistakes I see of all things are 401ks that are sitting at previous companies that are not being looked at. You can roll those over to an IRA and have access to any investment out there, yet I see people just kind of forgetting about it. Some other mistakes that I see that go along with that is beneficiaries are wrong, and you have the ex-wife as the beneficiary, or you have no estate plan, and then we got mixed second marriages and stuff like that. And boy, what a issue there. You could be investing too conservatively, or in many cases, you've been investing very aggressively over a long period of time, and now you're getting near retirement and you're too aggressive. We don't have a tax plan in place. I see all these things on the offense that cause problems. And so what we do as a financial advisory firm, we look at all this kind of stuff. And it's funny, I tell people, I train my guys, been doing this for 40 years. I've got a lot of very experienced advisors. And I always tell our clients, just try to stump us, because we really take serious what we do. And if we don't have the answer, we're probably affiliated with someone that does have the answer. And so what you want to do is you want to offload to people in lots of areas that have more information and experience. And so that's what we do. So if you would like to do a 30-minute phone call and get some good advice over the phone, find out if we would be a good match for you, I would encourage you to go to roymatlockjr.com. You might want to just go download some of our resources. We have all of my radio shows, which go back, to 2018, are in the Roy Matlock Jr. Money Business Hour podcast, and you can get that. You can go anywhere to get that. But the resources that we provide are designed to educate you on money, helping you avoid mistakes and growing wealth. I appreciate you listening. My name is Roy Matlock Jr. You can also reach us by phone at 615-843-2999, 615-843-2999. We'll see you next week.